Jordan, we're where we were at the beginning of the decade of the 70s. People notice inflation as a subject, but they haven't felt it as badly as they will. When they do, have no fear, gold will rock. The only ones that have come into the sector have come in drag.
Where's the money going to go? Is it just going to chase everything?
Yeah, it'll be stupid. The best in terms of risk to reward, I think, are the pre-feasibility developers with 5 million ounce or more deposits.
Hello again, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel and the Daily Gold podcast. We have another fantastic interview guest for you, and he's Rick Rule. So everybody knows who he is. We don't need to waste time on an introduction, but for those who are new and don't know who Rick Rule is, I'll just say, I'm not pandering to you, Rick, but nobody knows more about resource investing and nobody has made more money in resource investing than Rick Rule. And that's why we are so happy to bring him to you and get his insight and wisdom. Rick, I don't want to scratch your back anymore. Let's get to the questions. All right, we've done this before. Rapid fire. Hated, tolerated, or loved? Gold. Where does that come in now?
Tolerated. Market share of gold relative to other asset classes is still very, very low.
Yeah, so as a quick follow-up, so what would have to happen to get it to love? Would it take like a couple more years, 3 years, or
Time.
what are the signs when something goes from time? Okay.
Jordan, we're where we were at the beginning of the decade of the 70s. People notice inflation as a subject, but they haven't felt it as badly as they will. When they do, have no fear, gold will rock.
I completely agree with that, by the way. Silver, this is interesting. Hated, tolerated, or loved? Is it making it to the tolerated category yet?
It's flirting with tolerated. The silver bugs are angry. There's, all seven of them are angry about the fact that silver's outperformed gold, and they think in their time frames that it's underperformed gold. Pardon me. They think it should outperform gold. Most of the world doesn't know silver exists. My experience has been that when the generalist investor comes into a precious metals bull market, when the momentum has been established by gold, leadership changes to silver. I don't know when that will occur, but Jordan, you're not going to need me to tell you it has occurred. It's really dramatic when it does.
Okay, let me follow up and ask you about generalist investors coming into the sector. What point are we at the beginning of that, the middle of that? How long does it take them to come into the sector? Is it like something that can happen over a couple months? Or again, is this a process of years and years?
Jordan, the only ones that have come into the sector have come in drag. There are some ETFs that have been pulled into the gold space because they buy stocks with earnings momentum. They've been pulled into the Wheatons and the Agnico Eagles. The generalist investor can't spell gold, despite the fact that it's a four-letter word. We haven't seen anything. At the same time that we are seeing relatively good performance by a few gold stocks, we're still seeing money flow out of the indexes. The GDX, despite being up nicely, is having outflows, not inflows. So the only generalist investors that are in the gold space are what I would call gold investors in drag, people who are doing it inadvertently in index funds.
Yeah, someone asked me that question, by the way, or this question, I should say. I didn't have a good answer, so let me give it to you. How is that possible that money is coming out of the ETFs, yet GDX, GDXJ, they've really caught fire here?
It is amazing that investor perception around gold is so muted that retail money is flowing out of one of the best performing sectors in the market. This is not something that I've seen before. Well, first of all, there's been a lot of years where the GDX hasn't performed. To see the GDX perform as dramatically as it has, on the back of confirming data from the gold price itself, and see money flow out the index is something I haven't seen before. But I have no doubt that that'll self-correct.
Rick, given what you've said here, and I think I agree, and most of our viewers will agree, we're still early in a new secular bull market, again, as evidenced by your answers. But we have had a good move in a lot of stocks. A lot of the ones you mentioned a year or two ago, they've done fantastically well. So people are buying those. They're running up here. We're not seeing just the tremendous value in the top tier juniors that we had a couple of years ago. At this point, I mean, let's just say you're focusing on gold and silver juniors, the various companies. At this point, does your strategy shift at all? Is it still all about finding value? As a buyer, how might your strategy shift?
I'm true to what I do. There are lots of ways to win. There are people who are technical traders. There are people who are momentum traders. There are people who are sentiment traders. That's not what I am. I'm an investor. And by education, I'm a value investor. So I use the strategy that's worked for me that I'm comfortable employing. Because I'm comfortable employing my strategies, I'm unimpacted by volatility. People that have never developed a strategy or don't follow their strategy tend to be shaken out of their investments during times when they mistake volatility for risk. So I never change what I do. There was a time in the early part of the decade of the 90s when optionality was free. Nobody expected the gold or silver price to rise. And so you could buy gold assets in the ground for $5 an ounce, $10 an ounce, understanding that if gold repriced, that those assets would underprice. That worked because nobody was buying gold optionality. People buy gold optionality now. So in order to participate in that game, you're exposed to things like $2 billion market caps, which I don't do. I'm an absolute value guy, not a relative value guy. There are lots of other ways that work for people who are good at them, but that's what works for me. It's what I understand, so it's what I do.
What are the metrics that you use to evaluate value? And if metals prices are one of those, and if just for the listener, I mean, if you're looking at something that, do you evaluate that at 3,500 gold, 2,500 gold, 3,000 gold? Same thing for silver, broke above 35 today. I didn't see where it closed. Is it $30 silver, 28, 26, 32?
I construct a rough valuation metric. And when I say rough, I mean really rough. And for gold, I use the forward strip, which is to say basically 3,500. I use a 20% discount and I use a 20% premium. And so I actually construct three models. And I look at my downside stress risk, which throws out the high cost producers. And I look at all three valuation scenarios. I have a bias as to where the gold price is going to go, but I don't know when, and I don't even know if I'm right. So for me, I use a pricing matrix.
Okay. You gave me a great answer to something a couple of years ago when we did an interview, and I want to hear it again because I've forgotten part of it.
I hope I
But
remember.
I think this is, yeah, I think this is really valuable because you see this in other sectors where the leaders, the best companies in a bull market, they just keep going up. They get more and more expensive to some degree. And so far, we've seen that to this point where a lot of investors, they've bought juniors or exploration stocks that have done nothing to this point, whereas a lot of other stocks have done really, really well. You know, the top tier. Can you speak to, and I know there's a Buffettism here, but can you speak to why these stocks that have gone up a lot, but they're the best of the best, they're still a good value, why they keep going higher in a bull market, even though they appear expensive at some point?
I would argue that by valuation metrics, using current gold prices, Agnico Eagle is cheaper after it doubled than it was before it doubled. I look at discounted free cash flows, and I look at the free cash flows that they were able to generate in 2023 versus the free cash flows that they're able to generate in 2025. And by those metrics, the stock is cheaper now than it was when it was selling at half the price. Remember that part of the equation is price, but most of the equation is value. I do a couple things. I compare enterprise value, which is to say equity plus debt minus cash, and I compare that to my estimate of the net present value of the company's assets from the assets that are currently in production, and I add to that expected net present value from their project pipeline. When I do that for Agnico Eagle, I'm not going to give you the number, but despite the fact that it's gone up, it's doubled, it's cheaper than it was before it doubled. Moves in gold prices affect first the companies that produce large amounts of gold. You can have a junior that's looking for gold, and the fact that the gold price goes up shouldn't really matter much to them because they don't have any. If the price of something you don't have any of goes up, who cares? The second thing is, Jordan, and I've learned this the hard way. I've graded tens of thousands of portfolios, as you know, for free over 30 years. And I've learned that most people aren't willing to do the work to be speculators. They should be investors. In a gold bull market, the beta, which is to say the index itself, generates 300 or 400 or 500% returns. You can buy most of the beta in the 4 or 5 best gold companies. Maybe you underperform the average because they actually don't have the leverage that the lousy companies do. But you can buy 85% of the beta for 10% of the risk by buying the best of the best, and then you can get on with your life. You can go fishing or go gardening or read books or play with your kids. And for people who aren't addicted to it like me, that's a good answer. That's a good thing to do.
Okay, Rick, for newbies that are coming into the sector, maybe they've seen some of your interviews, they've subscribed to a couple newsletters. And I know this is probably a commercial for the your conference in the real classroom, but what advice would you give those newbies who they understand the macro that favors precious metals? They see they're performing well, they know they're relatively early, but they really don't know a whole lot in the sector. What kind of advice or guidance could you give them?
Well, at risk of being self-serving, which of course I am, uh, the real classroom is very good. There's 200 hours of instructional programming there, including 11 hours of real how-to called Introduction to Natural Resource Investing. There's a lot of free sources, there's a lot of paid sources, and a lot of them are good. It's important that you consume sources that communicate to you. There are people out there who I can't imagine this, Jordan, but they consider me to be an arrogant, smug human being. They probably shouldn't go to the real classroom. I am who I am. And if you can't consume the information from me, there are other places to get it. But the point is, do it. I think the important thing, Jordan, that people must do when they come into the sector is they have to do what you did. They have to assess themselves. They have to assess their strengths, their weaknesses, their goals, their timeframes. And then they have to begin the process of systematic education. The sector doesn't change that much. Past is prologue, but you have to do the work to understand what the past was so that you can use it as prologue. You did the work. And newbies to the sector need to ask themselves whether or not they're willing to do the work. Does it interest them? If it doesn't, if they understand the gold narrative and they want to use gold to protect themselves in the future, they should buy some gold and they should buy the best of the gold stocks, the best, and they should get on with their life. If, by contrast, they begin to get absorbed by it, they have competitive instincts or intellectual instincts like your own that suggest that they want to outcompete the beta, that they want to generate alpha, that's very different. Then they need to begin the process of outcompeting other investors. And you do that by having better access to information and a better ability to assess information.
Okay, that's great. Thank you for that, Rick. And just as a quick follow-up, what are like the one or two biggest mistakes that investors who come into this sector make? So maybe you could help them out quickly here, just something they
First
can
is,
really avoid.
first is laziness. Investing is hard work. I ask people to have the number of stocks in their portfolio that correspond with the number of hours per month they spend studying the stocks. And that doesn't mean listening to podcasts. It means reading 10Ks and 10Qs and proxies and resource statements. The slug work, listening to the quarterly analyst calls, which are free. If you aren't willing to spend 10 hours a month, you shouldn't own 10 stocks. You shouldn't do that. So the first thing is laziness. The second is a mismatch between their strategy and their tactics, particularly around time. Many resource investors have come to the space understanding the timeframes required in resources. They see something where supply is short, where the industry is in liquidation. They understand the contrarian thesis. They buy because they think electricity demand is going to go up, and therefore the copper price is going to go up. They understand intuitively that it's going to take 5 or 6 or 7 years for that to happen. But then they have trauma holding a copper stock over a long weekend. The juxtaposition between the time required to affect one's strategy and the tactics that one uses with their own holdings is probably the biggest preventable investment mistake that I see. I buy these stocks with the anticipation of a 5 or 6 year holding period, or if it's an exploration stock, I buy it with the anticipation of an 18-month holding. If you buy a stock because you think that the drilling campaign will confirm the work done with geophysics and surface exploration, and you understand, as an example, in northern Canada, that will require 2 field seasons, what that means is that the reason that you bought the stock likely will not occur for 18 months. if you aren't prepared to hold the stock for 18 months, why would you buy it in anticipation of an event that you won't see? But many people do that. Another thing, Jordan, which is going to really greatly amuse you, and most of your listeners will screw up, is in a bull market, something we haven't seen yet, or at least your listeners haven't seen for a long time. There will be occasions when I buy a stock in anticipation of the answer of unanswered questions, let's say the aforementioned drilling campaign. And the greed associated with that possible outcome takes hold of the market. There are occasions where stocks appreciate to my target before the unanswered question has been answered. In those cases, I always sell enough stock, irrespective of what I think the outcome might be, that I de-risk it. If my target is met before my question is answered, I always sell enough stock to get my capital back. Sometimes I sell it all. If you come into a market where you're making money too easily, you got to remember everybody else is making money too easily, and you're coming to the end of a good thing, and you haven't made the money if you don't get to keep it.
Okay, so making money too easily. Some people might get the idea that's been happening in the last couple of weeks or so.
Uranium stocks, Jordan, has happened to me. The last time we talked, the uranium stocks were deeply out of favor. People hated them all. You could look on the internet, and people that had uranium as part of their internet handle were capitulating. Doesn't get better than that. So, although I had a good position in uranium, I bought some of the uranium stocks just in anticipation of the removal of hate from the trade. And I've been selling those positions. My reason to own the stock has now gone away, so the stock has to go away. By nature, I'm not a trader, but I remember back many years when I used to run a fairly large retail brokerage firm. One of the things I would do is every day I'd go into the cage, and any day where 80% of the transactions or more were buy transactions, I'd sell something. I decided the market was overbought. And any day where 80% of the transactions were sell transactions, I'd buy something, figuring the market was oversold. And occasionally I made a mistake, but I got to tell you, that was the only trading strategy I ever was around in my life that really worked for me. I'm not normally a short-term guy, but I love hate. And paradoxically, I hate love.
Okay, Rick, let's get into exploration stocks.
Great.
Is there, I mean, this question, I'm thinking of how to phrase it. Is there some way we can track when money is starting to come into the exploration stocks, like an early example of that? I know some people say it's the junior index, the CDNX, or it's financings. I'm a technical guy. I like looking at data, numbers, and charts, and I can't find like an indicator or two, at least quantitatively, that would signal, okay, money is starting to come into the exploration stocks. And not to babble on here with a super long question, Rick, but there's so many of them that it's hard to, you can't, you don't have the time to look at like 1,000 different stocks. So I don't know if you get where I'm coming from here, but
I
what
do.
is there any way we could track that and get a sense of, okay, now now people are starting to buy the exploration stocks?
First, let me suggest that you're better at data analytics and data acquisition than I. The informal tool that I've used for 30 years has been the frequency or infrequency of transactions by prospect generators. When I see prospect generators in their quarterly reports to shareholders showing increases in transactions, which is to say them being able to farm out more projects than they were a year earlier, when I see this across the length and breadth of the 40-something prospect generators that exist, I know that the game is on. I know that the financing window is open. I know that management teams who haven't taken on projects because they'd prefer to get paid salaries are becoming more aggressive, and that means that money is becoming available. There are probably more efficient indexes than that, but I don't know them. I follow funds by actually follow funds, which is to say, when I see transactions that are being funded by the vendors, then I know money's back in the space. And by the way, money's back in the space.
So you think money is now starting to come into the
I know it.
exploration stocks?
I know it. The second thing I see is in a very small population of high quality exploration stocks, and this has been true for 2 years actually, their private placements are overfunded. I'm a fairly well-known investor, and many companies tell me that having me on their register or being able to announce me in a press release is a positive for them. And I find myself, despite this alleged advantage, being cut back in financings. That's not the mark of an underfunded sector. Now, the lame, the halt, and the blind, the dross, which is 85% of the listings, they're still having difficulty raising money because the investors haven't totally taken leave of their senses yet. Most of the sector shouldn't be financed. It should be allowed to return to its intrinsic value, which is zero. But in the better part of the sector, there's a lot of money around. Interestingly, it isn't generalist money yet. When I look at the roster of investors in the better juniors, they're all names I know, or not all names I know, but the majority of the population is names I know. The second thing I'm seeing is in the very small specialist funds, the 50 or $100 million exploration funds, they're all experiencing very strong inflows of capital. I did an interview yesterday with the CEO of Agnico Eagle, and I asked him various things about their growth strategy. And he said part of it is providing equity capital for very high quality juniors. He points out that as an example, if they go into a new region or a new country, just establishing the office, hiring the people, staffing it is $1.5 million bucks. If he can buy, 10% or 15% of an established junior with the right to participate in the projects that they generate or whatever, that investment has, in a sense, paid for itself on day one. And you are seeing a lot of participation in the junior space from the industry itself, which is important. You're not seeing it, the kind of stocks I'm referring to, the $5 million market cap where general and administrative expense is 60% of total expenditures. You're not seeing it there, and hopefully you won't. But among the legitimate juniors, money's back in the space.
Yeah, quick follow-up. So the big money that's coming into these funds, the inflows that you spoke about, did that really start to begin 3 months ago, a month ago, 6 months ago, 2 months ago? Could you pinpoint a time when that started happening?
I'd say it really opened up 6 months ago. I started receiving inquiries from family offices about the space in spades about 2 years ago. Paradoxically, after I retired. Maybe that's why they got around to calling me. But I started noticing that family offices, particularly from the oil and gas space, but I noticed an uptick in interest from family offices beginning 2 years ago. And that's only increased. The inbound inquiries I get from not generalist investors that are institutional investors, but generalist investors that are big league private investors is very high in the space.
Okay. Which part of the gold and silver juniors do you think offers the best value or opportunity right at this moment? And I'll just throw out some segments. Like, is it junior gold producers, junior silver producers? Is it the gold developers, silver developers, developers as a whole, or is it exploration in one of those areas? Could you pinpoint what you think might be the best of all those segments right now, the best value?
The best in terms of risk to reward, I think, are the pre-feasibility developers with 5 million ounce or more deposits. I look at Snowline, it's up 1,000%, but it's still cheap relative to what they have. It's likely to stay cheap until they announce permitting and construction. So if you're looking at it in a 6-month time frame, you may be very unhappy. If you look at it over the course of a bull market or minimally in a 4 or 5 year time frame, 10 million ounce deposits of 2 gram plus material are very rare beasts. So things like that are attractive to me. The sector that's always the cheapest relative to probabilities is the prospect generators, because the narrative is too commonsensical for exploration speculators. The idea that the business is a knowledge business, not an asset business, and that you don't dilute yourself at the company level, which is the knowledge level, but rather you dilute yourself at the asset level, which has a 1 in 3,000 chance of coming true. Those are always the best relative values. And over the 5 year time frame, confining your investments to the prospect generators to the expense of every other single class likely gives you the best risk adjusted rate of return in the space. Very few people are willing to give up the adrenaline rush of drill hole play exploration in favor of the pure arithmetic of prospect generators. And I have to admit that I don't do it either. I would be better off probably if I confined myself to owning 9.9 or 19.9 of every prospect generator and did nothing else. But then I'd have too much spare time. I wouldn't be able to confine myself to arithmetic sanity.
Rick, I want to circle back and talk about the junior silver stocks because, and I know that you know this, for me, I'm not a geologist. It doesn't seem like there's that many top tier, like tier one
All right.
silver projects out there. All the best ones are being acquired. Rick, a few more get acquired. What happens if silver goes to 50 or even breaks above 50 and there's a lack of silver high quality projects out there because they've already been acquired? That kind of frenzy that could be coming. What are your thoughts on that? Like, where is the money going to go? Is it just going to chase everything?
Yeah, it'll be stupid. There's a whole bunch of silver dross out there, little companies whose real exposure to silver is confined to the fact that they have silver on the name of the company and the share certificate. The price of something goes up and you don't have any. It shouldn't matter very much, but I guess sentiment matters. The phenomenon that you describe is extremely important for people to understand. I experienced it personally in the early part of the decade of the 90s, where I was part of the genesis of both Silver Standard and Pan American Silver. Those two companies escalated from our first financings, 50 cents on Pan American and 72 on Silver Standard, to 5 or 6 years later, plus $40 bids. People don't understand the upside in legitimate silver juniors. They're the most volatile asset class in resources that I know of. The caveat is that you have to be involved not merely with narrative, but with high quality people, with Ross Beatty's and Bob Quartermain's, and high quality deposits. There are a few of those out there. I would suggest that Abra is high quality. I would suggest that Vizsla is high quality. I would suggest that Aya is high quality. And there are a couple others knocking on the door. As you suggest, a couple of the small producers, Gatos and Silvercrest, got gobbled up. That's okay. Got paid a nice premium. If you wanted, you could take shares in the acquirer so that in the run up in silver prices, that deposit will continue to benefit you. But there's a lot to be said for doing the work to establish a 5 stock position among the silver juniors and then just relaxing until the generalist investor comes into space. I've never seen a frenzy around anything, with the exception of uranium in 2002, that resembled the silver frenzy, the junior silver frenzy that I experienced in 1992, 1993, 1994, and 1995. It was unlike anything. I was identified as the sort of promoter between Pan American and Silver Standard. And institutional investors would call me up saying, "How are you doing this?" And I would say to them, "Well, that's a trade secret. It's not available." The truth is, I wasn't doing anything. The market went absolutely crazy.
Rick, can you give your little spiel again about confusing bull market and brains? Because at this point, a lot of us, I'm starting to get emails, people complimenting me. Oh, everything's going so well. And, I've ridden through a few ups and downs, so I get it. But
You've been there before.
yeah, but for a lot of people, they really need to understand, like, it's a bull market. You don't confuse your brains with a bull market. And I'd love for you to just quickly remind everybody that.
A bull market, what happens in a bull market for people who were early in the bull market, they bought a narrative before the narrative came true. And as the narrative begins to be demonstrated by the price appreciation of the product in hand, that very price appreciation justifies the narrative. But that price appreciation devalues the narrative. In other words, if you think the gold price is going to triple, and then the gold price triples, your narrative is done. Perversely, you believe in it even more because you feel good, particularly if you were tested early in the period. I, as I've told you, Jordan, came into the market in the 1970s, the wildest bull market that resources have ever seen. I had the good fortune to come into it very early. And because I was naive, I played it very aggressively. And as a consequence of playing it aggressively, I outperformed many people who were substantially smarter than I. And I came to believe perversely as a young testosterone-driven male that my performance had to do with my genius, ignoring the fact that the gold price went from $35 to 850 and the oil price went from $2 to $30. And I ignored too the fact that markets work, that the cure for high prices, including commodities, is high prices, including commodities, and that the market would correct. And come about 1982, when that commodity bubble burst, I learned just how smart I was, which is to say, not very. The good news is that I have been able to guard against my own hubris ever since. I have been able to say, Rick, is this getting too easy? You are starting to make money on your mistakes. Do you remember how bad you felt when you went from being a wealthy young man to having a negative net worth? The answer to that question, by the way, is yes. And I have managed ever since 1982 downdraft, I have remembered to take advantage of the bull markets. I remember once in Midland, Texas, after the crash in oil that occurred in the mid 80s, seeing a wonderful bumper sticker on a car. Said, God, one more bull market. I promise not to waste this one. And I remind myself of that, just like I reminded myself a couple of weeks ago that the reason that I had bought added positions in the uranium juniors was because they were going to overcome hate. And for that part of my position, not my whole uranium position, but the part that was bought in anticipation of overcoming the hate, when that goal was met, I had to sell a stock.
Fantastic, Rick. As we wrap up here, you talk about the importance of education, people not being lazy. Tell them how they can come to your conference.
Love to do that. Let me tell you about the conference a little bit first, if you don't mind. The conference is, I'm told, in its 30th year. I'm also told I've run it for 30 years, which seems hard for me to believe, but let's leave that alone. We've tried to make the conference a little bit better every year. And if you do that for 30 years, it ends up being pretty good. What's different about it? Well, first of all, when we do global macro, we don't have failed journalists talking about global macro. We have players. We have David Stockman talking about the budget. He ran the Office of Management and Budget under Reagan. He was around for the first failure of the Department of Government Efficiency. There's nobody who can talk about the process better than a guy who shaped it. When we talk about the Fed, we don't have some Wall Street Journal journalist Pinko from Columbia University. We have Daniela DiMartino Booth, who was a researcher at the Fed. When we talk about the corrupt nature of Wall Street, we have Nomi Prinz, who was a partner at Goldman Sachs. So we try to do macro differently. We try only to have players comment. We go from there to markets. Once we have ascertained the world the way we think it is, as opposed to the way the big thinkers wish us to believe it was, we go to analysts and portfolio managers who've made money through thick and thin in resource markets for 30 or 40 years. Seasoned veterans who have been through bull markets and bears, who, like you, have been geniuses, have been goats for a long time. And that's really important for even veteran investors. Another differentiator, Jordan, and you know this, is that every exhibitor at our conference is owned in accounts owned and managed by the conference sponsors. We vet every single company. We turn down more exhibitors than we accept. There's no guarantee, sadly, that if I own a stock, it goes up. But there is a guarantee that I vetted that company. At every other mining investment conference I know, the qualification to be an exhibitor is a check that cashes, not a stout test. At our conference, we have to know you well enough to own you. The best feature at the conference, I think, is the living legends. We have a group of people, the Robert Friedlands, the Ross Beatties, the Bob Quartermains of the world, who have built multi-billion-dollar companies from scratch. And their experiences are invaluable. Their specific instruction as to how to identify a $20 million company that'll become a $3 billion company is, from my point of view, one of the best features of the conference. Another thing to know about the conference is if you don't want to work hard, don't come. We're going to give you between 50 and 55 hours of programming over 4 days, more than you can absorb. So we make the entire proceedings, we record them all, and we make them available to you for a year. To get the most out of the conference, you're going to have to play those again. And the other thing we do is that I interview every single exhibitor before the conference. Those interviews are at my YouTube channel. They're free, whether or not you attend the conference. Use them. By all means, use them. The most unbelievable thing about the conference, I think, is that it's the only investment conference in the world that I know of that has a no condition money back guarantee. Whether you attend the conference live in Boca, which is what I would prefer, or whether you join 2,000 other investors from 33 countries watching the conference on live stream, if you don't believe for any reason that I haven't delivered the value I promised you, I'll give you your money back.
I think people can view that online. If they can't make it, they can view the whole thing online with access into the future.
Live stream is a really, really, really good option. We've invested a lot of money in the technology. We have a reporter, Paul Harris from the Mining Journal, who handles the live stream. It's really, really a good service.
Okay, Rick, and before I let you go, tell us about Battle Bank. For people out there who are unhappy with their bank or looking for a new option, why should they consider Battle Bank?
Well, first of all, Battle Bank is run by veteran bankers. We're not rock and roll guys. Battle Bank is a community bank, except for we don't define community by geography. We define community by interest. Self-actualized investors, people who don't want to be fed Wall Street pablum. Here's an example. The average interest rate paid on checking accounts in the United States is 0.005%.
Yikes.
At Battle Bank, we pay money market interest on your checking account. If you're interested in interest, check out Battle Bank. Another reason, Jordan, is that we're coming into a period of currency turmoil. I'm certain about this. At Battle Bank, if you want to save in a currency outside the US dollar, we have money market and CDs available in 20 currencies, not just the US dollar. Another thing that should be of interest to people your age is that at Battle Bank, your IRA is really truly your IRA. At most banks, your IRA is a receptacle for Wall Street annuities and mutual funds. With a checkbook IRA, you can buy a duplex or triplex that you operate. You can buy a franchise or a small business. You can buy crypto. You can participate in private equity. Your IRA is your IRA at Battle Bank. The one thing that you can't do is buy a vacation home that you inhabit yourself. If you buy a vacation home in your IRA, you have to rent it out. It has to be a third-party transaction. But there are very few institutions that offer an IRA that is truly self-managed. We do. Of real interest to your customers is that unlike any other bank in the United States, Battle Bank considers gold, silver, and platinum and palladium good collateral. And we'll have the first customized retail product for bullion loans in the United States. So you can maintain your savings in bullion, but access the credit as those needs arise. Let's say to put down a down payment on a duplex or something like that, secured by gold and silver. We've identified about $33 billion in physical gold and silver in high quality repositories that we're happy to lend against. So you can see that we're attempting to be a community bank where you define community by interest and aspiration rather than by locale. If that's useful to you, by the way, there's no branches. This is online only. So if you aren't technologically competent enough that your phone or your computer is our branch, you're the wrong customer for us. Myself, I go into my big box branch up here in Northwestern Washington. Wonderful, wonderful, wonderful manager, but she doesn't know very much about banking. That's of less use to me, I walk in with a question about a deposit product, and she points me to a white courtesy phone connecting me to India. I'll pass, thank you. Particularly when she has 17 deposit products, 6 of which don't pay me interest. I don't have interest in not getting interest. So if you share that sort of aspiration and capability, we'd love to see you at Battle Bank.
Fantastic. And last thing, Rick, before I forget, anyone who has not yet had the pleasure of you ranking or rating their portfolio and all their positions, how can they get that from you?
Yeah, 2 things. And these are free. That's a really good price, free. Go to ruleinvestmentmedia.com, list your natural resource stocks, sidebar, no crypto, no pot stocks, no tech stocks, just natural resource stocks, and I'll rank them for free. Be patient. I'm about 250 rankings behind, but email them to me. Let's say that differently. Go to ruleinvestmentmedia.com, download your stocks, I'll rank them and send them back. The second thing is the Rule Classroom is a really good deal. There's a couple hundred hours of instructional programming. There's 12,000 members who've put themselves through the course discussing various stocks and various strategies. It's all free. Like the ranking. Of course, Jordan, given that it's free, it comes with an ironclad money back guarantee. By all means, avail yourself of this. It's free and it's valuable.
Rick, on that note, thank you so much for taking the time to interview with us today. I and my listeners, we really appreciate it. And I hope the listeners take you up on all of that, all the services that you offer. And again, thank you so much, Rick, and I hope we can do this again later this year.
Thank you, Jordan. I look forward to it. Thank you.